We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Adrian Day, CEO of Adrian Day Asset Management and manager of Euro-Pacific Gold Fund. Adrian, thanks for joining me. How are you?
Thank you very much for having me, Tom. It's really an honor because you're hitting them for six, as we say in England, or knocking them out of a ballpark recently. I just finished listening to the interviews with Danielle DeMartino Booth and Ronnie Stoffler. They were just wonderful interviews. And then I'm halfway through Rick Rule's interview. So you're really hitting it for six recently.
Well, I really appreciate that feedback, Adrian. And it's always, let's say, very, very humbling to know that, guys like you are actually listening to these interviews and, not just just the average investor or person trying to figure out what the hell is going on within the world or within the gold market. So I really appreciate that feedback.
Good.
So
Good.
Adrian, I thought we could start by, not necessarily focusing on the momentary news, but kind of this, let's say, longer arc here. Trump came in kind of towards the end of January 2025 here. And of course, the biggest thing that he changed was the way that the US wants to trade with the world. Of course, he brought in threats of big tariffs. There's been a lot of back and forth with that. But how do you think about the implementation of these tariffs and how that, let's say, is going to affect or not affect inflation going forward?
Yeah, no, good question. I mean, obviously, the tariffs are part of what is a potentially much bigger issue, which is a sort of reset of the whole world financial and monetary system. Trump and his advisors, they talk a lot about the US being ripped off. I think rip off is the word, ripped off by the rest of the world. And, there's obviously all these things have some truth to some degree or another. And I mean, obviously, if you look at what the US spends on the defense of Europe, for example, versus what European countries themselves spend on the defense of Europe, you can see the point. Mm-hmm. I do think they miss, with the whole monetary reset, to think that the US has been ripped off in trade, I think is a gross misunderstanding. And the US has the reserve currency. It was called years ago, I think it was Giscard d'Estaing, the French prime minister, decades ago, called having the reserve currency an exorbitant privilege. But there are responsibilities, but there are also privileges with having the world's reserve currency. And the privilege, of course, is that you can, if you have the world's reserve currency, you can print more money, print in quotes, you can print more money than you otherwise could be and export your inflation to other countries. So the US has had a better standard of living with lower inflation than it otherwise would have done if it had not had the world reserve currency. And I think it's very dangerous, frankly, to look at ending that. Now, that will end at some point. It always does. Mm-hmm. When Britain had the reserve currency, when the pound was the reserve currency, it ended. We can talk about that if you want, but it ended in 1945, and there was a handover or transition to the US, which at the time was obvious that the US was the world's dominant political, military, and economic power. Not only was it obvious, but it was acknowledged as such. There is no obvious replacement at the moment, so I think it may take a while. In the natural course of things, it may take a while before the US loses that. But with President Trump sort of trying to push a reset, that can be very dangerous, because if other countries do not take your dollars, then that inflation comes back home, right? I mean, at the moment, whether it's a Chinese central bank or the Colombian drug dealer or, the Romanian taxi driver or the girls in Thailand, everybody takes dollars. And they don't immediately switch those dollars into their local currencies because they're happy to hold them, right?
Mm-hmm.
But if you change that dynamic where people are not happy to hold dollars, whether it's official or unofficial, those dollars come back to the US. That leads to a lower US dollar, but it also leads to inflation, and it also leads to economic stagflation. And we saw that very much in Britain, right? After 1945, the pound was $5 to $1, and it fell over the next 30 years, 3 decades, to 1 to 1. And Britain had to go begging to the IMF for a loan to bail them out. Can that happen with the US? Well, if it loses its reserve status, it absolutely can. So anyway, long answer, sorry. And I don't know if I answered the question or if I got onto a tangent.
Well, no, you didn't answer the question, but we can come back to that. But, you said something there at the end of losing the reserve status. Is this something that we can, is kind of a binary outcome, or is there a place for, this multipolar, multi-reserve currency world going forward where the US still has a meaningful amount, just less than they had before?
That's an excellent question. And I think that's what Trump is wanting. He's wanting a multipolar world where you have the US and its allies, and we'll defend you, we'll pay for defense. You are allowed the privilege of trading with us without tariffs or with very low tariffs. And then you have the China-centric world where, we're not going to defend you, and, you'll pay for access to our markets. So, yes, it's not a binary at all. But to the extent that you lose that privilege, I mean, in that kind of multipolar world, I don't think China will be wanting to hold as many US dollars as it does currently, for example. So to the extent that you lose it, then the issues I talked about, lower dollar, higher inflation, come into play. But yeah, it's not binary by any means. And it's also not something that's going to happen overnight unless, for 2 reasons. But one main reason is there is no obvious replacement. Mm-hmm. In 1945, as I say, it was very obvious, even to thinking Englishmen, that our time was over. It was now America was the dominant power. 1815, it was pretty obvious because we just whipped Napoleon and exiled him. France's day was over. So, sometimes it's very, very obvious. There's no obvious, and the obvious replacement at that time was Britain and the British pound. There is no obvious replacement right now. The US, even if China's dominance in terms of economy and military grows, the US will go down kicking before it lets China become the dominant power. And of course, the Chinese capital markets are not deep enough for it to assume that role at the moment. I'm not suggesting in any way that's going to happen.
Mm-hmm. Well, Adrian, you also mentioned kind of at the beginning there this idea of a monetary reset. What do you think that looks like? In actually that conversation that I had with Rick Rule recently, he alluded to the same type of thing of a new Bretton Woods moment. So is there something like, an actual event like taking the dollar off the gold standard that you think is going to happen, that is going to kind of precipitate that new type of monetary reset as you
No, excellent question. And I think all of this is a little bit nebulous and vague at the moment. Mm-hmm. You've heard about the thing called the Mar-a-Lago Accord. which was a paper by Steve Mirren, who's now the chairman of the White House Council of Economic Advisors, back in, I think it was October or November, but just before the election. And there were a lot of ideas in there. And he's walked it back saying, it wasn't meant to be a policy statement. It wasn't a blueprint for what Trump is going to do. But nonetheless, all of those sort of ideas and the whole Mar-a-Lago thing, Mar-a-Lago Accord, as they call it, ties in to the thinking of President Trump and the people around him. Mm-hmm. The idea that the dollar is too strong and it's hurt in the US. Now, that's debatable because a strong dollar works both ways. There's losers with a strong dollar and there's winners. And the population of the US, particularly the lower half of the US, has been a winner with a high dollar in the sense that they've been able to import cheap goods from China. So be careful and other Southeast Asian countries, be careful what you wish for. You make the dollar a lot weaker and put tariffs on Vietnam and Malaysia and China and Vietnam. Did I say Vietnam? Mm-hmm. Then suddenly those goods, everyday goods like clothes. Have you been to Walmart? I don't know if you shop at Walmart. I don't. Except for my jeans. My jeans cost $16 at Walmart. I can't believe it. It's hardly worth washing them. You just throw them away. But anyway, but all that stuff comes from Bangladesh, Malaysia, Vietnam. Mm-hmm. And if those countries are excluded from the US market or have very high tariffs and the dollar is lower, then that hurts the people at the bottom half of the equation. But the idea that the dollar is too strong, the idea that other countries are ripping them off because they have monetary and non-monetary tariffs, blocks to trade. Again, there's some truth in that. I did a little sort of table of what it costs a Frenchman to buy a bottle of wine, what it costs a Canadian to buy an American bottle of wine. And the cost can be anywhere from $6 to $14 a bottle, mm-hmm. depending on the province you're in, for a Canadian to buy an American bottle of wine. For a US person to buy a Canadian bottle of wine, if anyone was foolish enough to do such a thing. But that was a joke. But for an American to buy a French bottle of wine or a Canadian bottle of wine, the highest would be Louisiana, New Orleans, Louisiana, which was like $8. But for most people in the US, it's $3 or $4. Mm-hmm. So that's not tariffs. That's excise duties. It's import duties. It's liquor taxes. It's all sorts of other things. But nonetheless, add all of the government taxes up, all of the money that goes to the government, and a Frenchman is spending an American bottle of wine in France costs a lot more than a French bottle of wine in America. And I think those are the sort of things that Trump is fighting against.
Mm-hmm. Well, I think you could also do that table for, let's say a liter of milk or a pound of butter, especially in Canada, because we have something like, I think it was a 400% tariff on any foreign dairy to protect the domestic dairy industry. So, for example, trying to buy grass-fed butter in Canada is actually almost impossible to find because, half the year cows are fed on hay and whatever other kind of feed that they give them because of the winter. And trying to buy, for example, like Kerrygold butter that is easy to find in the US is almost impossible here because of this massive markup that is literally just a protective tax on top of the actual product.
And you can see it in everything. You can see it in automobiles. Mm-hmm. The costs of exporting a US automobile to Italy or Germany. Now, again, if you live in Italy or Germany and want to buy an American car, I would say there's probably something wrong with you. But nonetheless, the the cost of exporting that is a lot more than the cost of importing German or Italian cars to America. But that's one aspect. I mean, the other thing is the idea of quid pro quos. And I know we're going to talk about funding a deficit at some point, but quid pro quo is like, we'll defend you if you buy our bonds. That's all part of this Mar-a-Lago, and it's not something that's going to be, a 20-point bill through Congress that's implemented overnight. It's going to be piecemeal. It's going to be backwards and forwards, as we've seen with the tariffs. But that's certainly the thinking behind the policies. Mm-hmm. Some of them are accurate, I think. Some of them are misguided, I think.
So, Adrian, before we move on to that quid pro quo and this idea of debt, if and when these tariffs do go through, that obviously adds to this tension for the U.S. economy and the average consumer. What do you think are let's say the biggest pieces of concern for you right now for the American economy? Is it jobs and the direction of the jobs reports? Is it credit card debt? Is it the student loans that have come back? What part of this, or is it all of it as a whole that is concerning?
I think all of it, and particularly the three things you've mentioned, plus tariffs, which will hurt in certain areas. Mm-hmm. I like cheddar cheese, real cheddar cheese from Cheddar in Somerset. Now, if there's a tariff, a 10% tariff on that, I'm still going to buy my cheddar cheese from Cheddar Gorge in Somerset. Mm-hmm. But a lot of people will say, you know what? I'll buy this Wisconsin rubber instead. I'll buy the Vermont or New York, which is reasonably good cheese, but I'll buy that instead. Mm-hmm. So I like Scotch whiskey. I'm going to buy Scotch whiskey. I'm not going to replace it with American bourbon or something. I'm going to buy Scotch whiskey. Mm-hmm. But if you look at other things like clothing, as I mentioned, all of the low-cost clothing comes from countries which at the moment are destined to have high tariffs, which will really affect the price of those things. Mm-hmm. Again, if you buy jeans at Walmart for $16 and there's a 20%, or well, in the case of some countries, they were talking about 40 or 50%, but if they go up to $20 or $21, for some people, that is a difference between whether you can buy them or whether you have to keep the existing jeans a little longer. And the same is true of shirts and everything. But I think with the U.S. economy, I've been saying this for a while, Tom, I think the U.S. economy is not anywhere near as strong as the headlines suggest. Mm-hmm. And Danielle DiMartino Booth was really excellent on that, by the way. But I don't think it's as strong as the headlines suggest. And this has nothing to do with Trump. This was happening well before Trump came into office or was elected in November. And so the headlines are misleading. You mentioned unemployment, for example, or employment generally. You look at employment, look at the last month. We had a reasonably good new jobs creation, right? From the Bureau of Labor Statistics. Reasonably good, beat estimates. Good, the market says good, they beat estimates, let's go up. But they also revised downwards the previous 2 months, and they revised downwards the previous 2 months by more than the new jobs that were created last month. Now, the problem is the headlines, because, the headlines for most newspapers around the world, around the country, they simply take the BLS press release and stick it in the paper. And the headline was X number of jobs created, a beat on estimates, and in the fourth or fifth or sixth paragraph, you get that there was a revision downwards. But the algorithms, and frankly, a lot of people only look at the headline. Oh, good. The and so the market responds to those headlines. So that's one thing, the revisions. The second thing, of course, and the most important thing, frankly, is that you look at the ADP. There's two big job surveys in the US: the Bureau of Labor Statistics, which is government, and the ADP, which is private. And one is a survey of private businesses. And you look at the ADP numbers, which are meaningfully, significantly lower than the Bureau of Labor Statistics. Even the Bureau of Labor Statistics reports even for private sector jobs. So there's something not aligning there. Now, I'm never going to jump, first of all, to saying the government is manipulating the numbers. That's not my default answer. Mm-hmm. But either the government is manipulating the numbers, or they're totally incompetent, or it's just too difficult to calculate jobs. And I think with more people having part-time jobs, more people working remotely, more people doing independent, being not being employees but working independently, maybe the methodology that the BLS uses is outdated. Maybe that's the answer. But there's a disconnect, and a very wide disconnect, between the ADP private numbers and the Bureau of Labor Statistics. And then the last thing I'll say on employment, because I know I'm boring you, is you look at the last 12 months, literally, in the last 12 months, according to Bureau of Labor Statistics, the majority, and I mean that majority of jobs created have either been government jobs, not federal, but local and state, government jobs or part-time jobs. Now, if the majority of your new jobs are part-time or government, and when you look at the part-time jobs, you see that overwhelmingly the majority of people who take part-time jobs were looking for a full-time job. Mm-hmm. That's not a healthy economy. That is not a healthy jobs market at all. Mm-hmm. We could go through, retail sales and do the same sort of analysis. We could look at a lot of sectors of the economy and see that they're just not as strong as the headlines suggest.
So on the other side of that, Adrian, obviously we have the ability of the US to finance itself and be able to continue deficit spending the way it basically not always has, but for the meaningful past always has. How do you see the appetite for US debt going forward here? And you mentioned that idea of the quid pro quo. How does that relationship continue with, in this environment that is so dynamic?
That's an excellent question. And frankly, I think that is going to be one of the biggest issues, economic monetary issues of this year, with implications for the market. Now, there's two parts to this. There's the longer term part, and then there's the shorter term part. Let's deal with the shorter term part first. The federal government, the fiscal year for the federal government in the US ends September 31. In between, and I can't help being political here, I'm sorry, but in between the election and Trump taking office, the Biden administration spent virtually everything that had been appropriated for the full year. They spent a whole lot in 3 months, two and a half months. Janet Yellen, the Treasury Secretary, gave an infamous interview on a Friday night before Trump was sworn in on the Monday, which should have got more publicity, basically saying, she said, but the US would hit the debt ceiling. There's a debt ceiling in the US. Everybody knows about that. There's a debt ceiling where by law, the US can't borrow above that debt ceiling. They keep changing.
Until we adjust.
But nonetheless, by law, they can't borrow. And Janet Yellen said on the Friday night, but the US federal government would hit the debt ceiling on Tuesday. Basically, I'm paraphrasing now, the cupboard's bare, good luck, Trump, is what she said. I think that's a travesty. That's outrageous. And so what you've seen this year with Scott Bessent, the new Treasury Secretary, who understands markets, who's very smart, but the Treasury has been unable to issue any net new debt this year. It has all been when treasuries mature, then they can issue new treasuries to replace the ones that are maturing. But no new debt issuance this year so far. That's why Trump and Scott Bessent, that's why they're so eager to get the debt ceiling lifted. Now, that's a whole different issue. We could talk about that separately, but I'm just saying they're so eager to get it lifted so that they can increase the debt, issue new treasuries. Now, they're talking about that being passed by July 4th. I think that's a very aggressive. That's aggressive and uncertain. Mm-hmm. But the point is whether you do it, even if they do it by July 4th, you're basically leaving yourself only half a fiscal year to issue a full year's worth of debt. Mm-hmm. So the longer that is delayed before they lift or raise the debt ceiling, and whether they should or not is a different issue, right? We're not going there at the moment. But the longer you leave it before they raise that, then the more money has to be raised in a shorter period of time. Maybe something like 600 billion has to be raised. I don't think they're going to raise it till the end of August. So basically, they've got September, maybe half of August. So you've got half of August and September. That's going to be a lot of money raised in a very short period of time, a lot of catch up. But even if they do it July 4th, you're only talking July, August, September. You're only talking 3 months out of 12. Mm-hmm. So the supply is going to be increased. That's the point I'm leading to. The supply is going to be increased dramatically in a very short period of time. And that is not even getting into how the debt is growing every year and everything else. We're just talking about this year. Now, on the demand side, we know that China and Japan, who are the two largest foreign holders of treasuries at the moment, are not buying. They are both selling at the margin for different reasons, but they're sellers. We know that US regional banks, which used to be a large buyer, are not buying because of a problem with Signature Bank and the mark-to-market. Remember all that stuff? Mm-hmm. And that's what caused them to go. So they're not buying long-term treasuries. The Social Security Fund is actually has no money to buy new treasuries. They're one of the largest holders. And the Federal Reserve, of course, and there's the key, the Federal Reserve is not buying treasuries at the moment, but they are selling as well with the QT program, quantitative tightening. So the only people buying treasuries at the moment, longer-term treasuries, I should say, are pension funds and insurance companies with long-dated liabilities, mutual funds, income mutual funds that are buying them, and frankly, hedge funds that are buying them to make a quick profit, and there's nothing wrong with that. But they're going. All of the hedge funds are going to want higher rates to buy long-term treasuries. Mm-hmm. So we're stuck
to buy or to hold long-term treasuries.
Well, even to buy them, because if they buy them and looking to sell them, they want to start from a higher place where rates have a possibility of coming down.
Right.
So you're left with a situation where this year, where you have a much larger supply coming on in a much shorter period of time, and at the same time, fewer buyers. And that links back to what we were talking about earlier with Trump. If Trump is antagonizing half of the world, including half of the world that buys US treasuries, that part of the demand is going to go down. Now, there's going to be no difficulty in selling treasuries at the short end, I don't think. You may have to increase a year. What is it now? A 3 month is what, 4.6 or something? You may have to go up to 5 or 5.25 to sell them. But there'll be no problems selling treasuries at the short end, right? Because frankly, it's not a bad place to put money right now. There's no other place where you can get higher yields at a reasonably similar risk than buying short-term treasuries. So they'll have no problem selling at the short end. that doesn't really do much for the US's long-term fundamental debt funding problem. They need to be issuing more 30-year and frankly even 50-year bonds to fund the debt. So there's two things that are going to come from this. One is we're going to assume that the debt ceiling is raised or lifted, right? We're going to make that assumption. But once it is lifted, then we still have these problems I'm talking about. Mm-hmm. And Scott Bessent and the Fed and the Treasury, they're using all sorts of tricks to get, 20 billion here, 50 billion there. As you know, they're talking to the major money center banks about doing away or reducing the requirement for banks to have so much on deposit with the Fed. And at the same time, Senator Cruz is introducing a measure to do away with interest that they pay on bank reserves. And before, I mean, you shook your head. A lot of people say, oh my gosh, that's crazy. But before 2008, the Fed didn't pay interest on bank deposits. That came in with the great financial crisis as an incentive to get banks to put more money on reserve.
Well, then that's exactly why I shook my head, was because, where does the incentive lie for them to deposit that with the Fed if there's no interest?
So the only incentive is if it's a requirement. Mm-hmm. And so they're going to reduce the requirement, the carrot, and they're not going to pay interest, which is the stick. But I can guarantee you, Tom, that the Fed is saying, but by the way, if we do this, we really want you to buy some treasuries. Guaranteed. Mm-hmm. Wells Fargo, that's about 250 billion max. That's assuming all of the money that's freed up goes into treasuries. Jamie Dimon, the CEO of JP Morgan, has already said we're not interested in increasing our holdings of treasuries. Mm-hmm. And there's other things like Wells Fargo, which was absolved of its 2008 sins. Guaranteed there was a handshake deal, or maybe not a handshake, but guaranteed there was a deal. Okay, we'll free that $50 billion, but we want you to buy some treasuries. Stable coins, the so-called Genius Act, which is a laughable title. But anyway, now there's a regulatory framework to encourage stable coins that are fully backed by treasuries. So you mentioned that earlier. So now there's another source of demand for treasuries. We don't know how much that's going to be this year. We don't know how much it's going to be longer term. It's probably not going to be that much this year, right? And when you add these various things up, these various ways of getting it from different people, maybe the Bank of England has been said, we gave you a great trade deal. Do you want to buy some treasuries? There's still going to be a gap, particularly in the longer term treasuries. And I suspect very strongly that gap will be met by the Fed. So the Fed, which has already basically stopped QT, I mean, Powell pretends they haven't, but they've gone from 35 billion a month to 25 billion a month to 5 billion a month. $5 billion a month with a balance sheet of almost 7 trillion is basically a rounding error. It's meaningless. Mm-hmm. And so QT is quantitative tightening, where they sell treasuries and reduce the balance sheet, is basically over. And I suspect that once the debt ceiling's raised, you're going to see the Fed go back to QE, and the Fed is going to be the buyer, as it was, for most of the last 10 years, or 15 years since 2008, is going to be a major buyer, if not the major buyer, of longer-term treasuries. Well, what does that mean? When they introduce QE again, it's going to be negative for the dollar. It's going to be negative for the bond market, in my view, but it's going to be wildly bullish for gold, mm-hmm. as it was last time.
Adrian, when we think about that condition of going back to QE from QT, back to quantitative easing from tightening, does that necessarily mean that the Fed is also going to lower rates at that point? Because those two things have historically gone very hand in hand.
That's an excellent question. Not necessarily, but it would be unlikely to see the Fed raise rates at the same time that they're doing QE. That would be a little counterproductive. I mean, we all know Jerome Powell, the Federal Reserve Chairman, has been reluctant to cut rates, partly because he's genuinely concerned about the volatility and the uncertainty. Mm-hmm. And if you've listened to his last two press conferences and listened to him in Congress today, uncertainty is the big takeaway you get. We don't know, so we want to sort of hold off and hold it in reserve. There is a certain legitimacy to that argument. I think he's completely wrong when he talks about they want to see what the inflationary impact. He doesn't want to cut rates before inflation is under control. Fine, I get that, but I think it's he's wrong. Frankly, he talks a lot about waiting to see what the impact of tariffs are on inflation. Mm-hmm. Well, tariffs, everybody's talking about tariffs being inflationary. Tariffs are not inflationary, they're deflationary. We should have learned that in 2017, the last time that Trump was in and instituted even a partial tariff program on China and other countries. That was very deflationary. Or disinflationary, I should say, to be correct. And then, of course, you only have to go back to 1930 when the US introduced tariffs on countries around the world. That was hardly inflationary. So I think history tells us, as well as just logic, if you raise the prices of certain goods, right, that's not inflation. You're reducing the demand for those goods, and people are going to lower cost items. Mm-hmm. As I mentioned, if you can't buy real cheddar cheese, you'll buy Wisconsin cheddar cheese, which is less expensive. And that, of course, is the whole point of the tariffs, to get people to buy local US-produced goods. So that's not inflationary. It's only inflationary if the US, if the Fed increases the money supply dramatically. But certain prices increasing are not inflationary if other prices are decreasing. So anyway, long-winded answer. But I think and the other issue, of course, sorry, I said there were two issues. Two reasons Powell was holding off. I mean, Powell is a human being, right? And when he is bullied, and there's no other word for it, when he's bullied by Trump to lower interest rates, what is the natural human response of anyone who has half a backbone? The natural response is to say no. Leave me alone. Make my own decision.
Especially somebody that is so concerned about his legacy and he only has, what is it, like 10 months left in his term?
Yeah, absolutely. So I think if Trump wants Powell to lower rates, the best thing he could do is leave him alone for a couple of months. But I think we'll probably see rates lower. And remember this, the two policies we mentioned about the QE and the rates. Mm-hmm. The lowering rates is a response to a weaker economy, right? Doesn't do anything for selling more bonds. Quantitative easing is a response to the debt issuance. That's not a response to the economy and doesn't do an awful lot for the economy. Mm-hmm. So they will lower rates when inflation looks under control and it's clear that the economy is slowing, in my view. And Trump keeps quiet for a month.
Clearer. Because they're so data dependent, but yet there's still so much uncertainty, which is, quite a tension between those two things.
Absolutely. Well, I don't know whether it's Daniel DiMartino Booth, but somebody has said, some of those or I'll say it, some of those 400 PhDs in economics, Peter Bookvar said this, those 400 PhDs in economics that sit in the Eccles building in Washington, D.C., take some of them away from their models and put them on the phone listening to corporate CEOs on their quarterly analyst calls. Then you will know exactly what corporate America is thinking of their response to tariffs. You don't have to wait for the data to come in. You don't have to have a model that you tweak. Just listen to what corporate CEOs are saying.
Yeah, it's a good point. Adrian, you mentioned this idea that once QE comes back in, that's basically another bullish factor for gold. Of course, over the last 3 years, we've seen tons of central bank buying really drive this market to new highs, and really has held its own in a lot of respects without too much of a pullback. What do you see as, let's say, the types of market participants that are missing in this bull market for precious metals versus previous markets?
Well, that's a leading question if ever I heard one, Tom.
Totally open-ended. You could take it anywhere you want.
I mean, we know who's missing, and that is Western, but particularly North American investors. And by investors, I don't necessarily mean retail. I'm including small institutions, family offices, generalist mutual funds. But the North American investor is who is missing from this market. Now, if you go back 3 years to when, gold started taking off, we've seen record buying from central banks. And then starting about a year ago, 10 months ago, we started seeing a big spurt in buying from China, from non-official China, from Chinese investors. And these people, the people who were buying gold were buying for their own specific reasons that had nothing to do with the global economic environment and nothing at all to do with the North American economic environment. And so, and again, we know why these people were buying. We don't have to go there. But they were independent factors. And those factors, by the way, I don't think have gone away. So I think that buying is going to continue. It'll ebb and flow. Chinese buying has slowed down a lot in the last 2 months, but it'll ebb and flow. But the reasons for the buying remain. Now, when you look at the typical North American investor, and again, I'm not talking just retail, I'm talking, family offices and so on. They will typically buy gold for economic reasons. And if you look at the last, say, 2 years, you've had an apparently strong US economy, you've had high interest rates, you've had low and declining inflation, and you've had a reasonably strong US dollar. Tom, can you think of an economic environment less conducive to buying gold than that? And then on top of that, you've had a strong S&P and a strong TSX. Why bother looking at gold stocks in that kind of environment? And so that shows up in the numbers. You look at the inflows, the flows on the GDX. We had a bit of a spurt starting in the end of May to the middle of May to the beginning of June. A little bit of an inflow spurt. Now it's gone right back to outflows. Look at the GDX, other than 2 or 3 very, very small days of net inflows, you have to go all the way back to last August to see inflows into the GDX. GDXJ, sorry. But the GDX has lost about $2.8 billion this year in net outflows. So, and then you look at family offices. You've probably seen, many of your people will have seen that pie chart. Less than 1% of family office assets are exposed to gold and silver. Bank of America did a study of registered investment advisors. It says 78% of registered investment advisors have less than 1% allocation to gold. And I'm betting you, but it's closer to zero. They didn't ask how many have zero. I bet you it's closer to zero than it is to one. Mm-hmm. And the numbers for, they had 1 to 5, 5 to 10. And the numbers for those were actually lower this year than they were 5 years ago. So North American investors, all of the evidence tells us that North American investors are still not interested in gold and gold assets. And that's because the economic environment is wrong. Now, you see the economy clearly slowing or inflation clearly picking up, or interest rates coming down, or QE coming in, or the dollar going down. See 2 or 3 of those, and then people will start to be interested in gold again in a big way.
Well, I mean, even just by comparison, the markets over the last 20 years, putting your money in the stock markets, these passive funds, any of this stuff, it's no wonder gold without basically a yield has fallen, not even out of favor, but out of even people's memories.
Well, yes and no. I mean, you look at gold. Let's go back to, I'm just going to pull something up. Let's go back to 1999. So that's a valid date. It's the beginning of the millennium. And it's going to take a little while. So gold has dramatically outperformed the S&P. Dramatically. Mm-hmm. Its performance, gold, is up 3 times as much as the S&P. Now, unfortunately, this table I'm looking at doesn't give you the dividend, doesn't include the dividend. I could do that separately. But the point is, gold has actually performed quite well over that period of time.
Totally.
And for the last 3 years, I would say until the last couple of months, it's really been a stealth rally where people were hardly talking about it. But I mean, gold has outperformed, gold and gold stocks have outperformed the S&P this year, and they've outperformed the S&P for the last 12 months. I don't think most people realize that. But the point I'm making is that if I'm invested in the S&P fund through my 401k, which I probably am, most of the money in the US market now is 401 money, and every year or every 6 months, you're an employee, you get a little thing saying, oh, it's time to revamp if you want to. Where do you want to put your money for the next 6 months? Well, you can put it in a bond fund, or you can put it in, there might be, if you're lucky, you might have a global fund, and you'll probably have a high growth fund, or a large cap fund, or a small cap fund in the US. But you won't see a gold fund, you won't see a resource fund, or you won't see an emerging market fund. And so people will say to me, I get this all the time from clients, and say, hey, in my company, I've got this 401, where should I put my money? What do you recommend? And I look at the list, it's no wonder that people put their money in the S&P, because you're not going to stick it in cash, and you don't want to put it in bonds, and you don't have a lot of other alternatives. And so long as the S&P just keeps going up month after month, people are going to stick it up. People are going to leave it there, regardless of the values and regardless of the performance, frankly, of other assets, in my view.
Mm-hmm. Well, Adrian, when we think about, what gold represents within the investing world, it's safety, and most people understand it as a hedge for inflation. But especially on the safety point, with the dramatic rise of conflict in the world over the last week and a half, one would think that gold would have responded, that the S&P would have responded, that the VIX would have responded, that oil especially would have responded. And yet we seem to have this major disconnect that the market really doesn't believe or doesn't think that this conflict is a big deal. Why do you think there's such a disconnect at this point?
No, that's a very valid point. I think there's two things. Yes, I was surprised that oil didn't move up more on Monday after the U.S. Entered the conflict, let alone the week before when Israel was bombing Iran. I think to some extent you had a little bit of a move in advance, so there was a little bit of the buy the rumor, sell the news. That's part of it. I think part of it also is that these things tend to have a bigger impact. Geopolitical events tend to have a bigger impact when investors think that the issue is going to get worse, right? It's going to deteriorate and get worse. And perhaps there was a sense that if you take out Iran's nuclear facilities, it's not going to get worse, that you've weakened Iran. But I think if you look at history, particularly for gold, I've done this for gold. I've looked back since 1980, since the 1979 Iran hostage situation. And I've looked at all the geopolitical events. And what you find is that typically the impact is very short-lived. You can see a spike, but it tends to be very short-lived. And frequently, you do get the issue of buy the rumor, sell the news. So you look back to, for example, the Russian invasion of Ukraine. You'll remember this. For 6 weeks before the tanks rolled across the border, there were all these stories, are they or aren't they? And there were all the massing of troops at the border, and people were debating, is Russia going to invade or not? And gold moved up meaningfully in those 6 weeks. As soon as the tanks rolled across the border, the day after was the peak for gold. And within 6 weeks, we were back to where we were before it started. And that is not, I mentioned that one because that's obviously the last, very major and out of the blue. That was the last major sort of geopolitical event. But it's true of 9/11. It was true of the U.S. invasion of Iraq. All of these political things tend to have very, very short impacts on gold. What really moves gold is the monetary issue more than a geopolitical.
Well, I think within 9 months or something of 9/11, exactly as you mentioned, gold moved up, backed off quite a bit, and then within 9 months it was almost double or something like that. I can't remember the exact numbers, but with that lag and that time, gold seems to respond to, maybe it's not the event, but as you said, it's maybe the monetary response to that.
I think it's a monetary response, but I think gold's move a year after 9/11 was not because of 9/11. It was because of, and there was clearly no follow through. There was a lot of concern, of course, at 9/11 that there'd be sort of similar attacks all over the world or all over the Western world. But the response of gold a year later was not a response to 9/11, in my view. It was a response to the monetary response to 9/11.
Yeah, and I mean, it's so hard to really pin down and give a black and white clean answer to any of these moves. But I think, using history as this guide, obviously it's not going to repeat exactly, but, looking at events, looking at what all of the inputs end up being, positive and or negative for obviously we're talking specifically about gold, but taking all these events together and then understanding the direction that takes once that scenario plays out is more instructive, I think, and a lot more helpful, because you're never going to get a clean black and white, here's why gold did X or Y, and it's never
absolutely.
that easy.
No, you're absolutely correct. And there's all these different factors, and different factors seem to weigh on investors differently at different times. There was a time when all we talked about was growth in the money supply. Nobody talks about the money supply anymore, so it didn't invest. But there was a time when trading stopped and everybody gathered around their ticker machines to see what the money supply was when the numbers came out. Mm-hmm. So different things have different weights at different times, as you're absolutely correct, and all these factors play into it, whether it's inflation or interest rates or the outlook for interest rates. All these factors play into it.
So, Adrian, over the last, let's say, 3 years as well, it seems to most within this space that there is a similar disconnect between the gold price and the value of the miners, or the value of the mining equities. So where do you think that disconnect comes from?
Well, Tom, I think it comes from exactly what I was talking about earlier, but the drivers of gold for the last 3 years have not been economic drivers, and they have not been Western and particularly North American investors. Mm-hmm. So if you're the People's Bank of China wanting to diversify away from your reserves away from the dollar because you're too concentrated in the dollar and you're concerned about dollar weaponization, well, the last thing you do is buy Newmont Mining, right? And if you're a Chinese investor worried about the decline in the yuan and you're a little bit worried about the fragility of the banking sector, you buy physical gold. You don't buy HX exploration. Mm-hmm. And so the buyers and the reasons that they buy have led people to physical gold. They haven't led people to silver. They've led people to physical gold, not to silver, not to gold stocks. And so that's why I think we've seen this disconnect. I think when you start to see the economic factors change, which we're seeing now, I think people are beginning to see that the US economy is slowing. The dollar is obviously, the US dollar has not been as strong as it was last year, And clearly people think that the Fed is going to cut rates before the end of the year. The dot plot that they had, their own predictions were for 2 rate cuts this year, just a little later than we thought they were going to be. So clearly those factors are beginning to change. And when you see the leaders, the Magnificent Seven and the other leaders of the S&P stumble, they don't have to collapse. They don't have to go bankrupt or anything like that. But just when you start to see them roll over and stumble, as we saw in February, then people start to look for other asset categories. And those categories, that could be, global markets, it could be emerging markets, it could be emerging debt, it could be commodities, it could be value stocks, small cap growth, but it will also be commodities and gold stocks. Mm-hmm. And the gold stocks are in, I think, an absolutely, even though they've gone up, 50% in the last 12 months or whatever the number is, gold stocks are in an ideal situation right now because not only is the commodity at more or less all-time record highs, gold stocks have not exhibited the leverage that we're used to seeing at the beginning of a bull market for the reasons we just talked about. But the margins are expanding. It's not only that the margins are high, the margins are expanding. Mm-hmm. You look back to 2011, the last time gold was, went to a peak. Oil was at $140 a barrel, and the Canadian dollar, the Australian dollar were both the premiums to the US dollar. The South African rand, the Brazilian real, all of these, what we call commodity currencies, were far stronger back then than they are now. So you look at this year, look at the last 12 months, and even though there's been some cost inflation in running and operating a mine, it has far and away lagged the rise in the price of gold. So, if the price of gold has gone up, it's almost tripled in the last 3 years. Costs have not done anything like that. And so the margins have been expanding. So when a company says our all-in sustaining costs have gone up from $1,250 to $1,400 or $1,350, well, $1,400 when you're selling a product at $3,300, that's a huge increase in the margin. And so you look at the last 5 quarters, and the gold mining sector has had expanding free cash flow for each of those last 5 quarters. there is no other sector, industry group in the US with higher growth in margins than the gold mining sector. And I think people are beginning to see that. Now you put all of that together, and then you look at the valuations. Just to give two examples that I always give, Barrick, which has its own issues, but Barrick on a price to NAV is selling in its lowest decile price to NAV in its entire history. And normally, of course, when you have record prices for gold, you get multiple expansion. You don't get multiple contraction. You look at Agnico. Agnico's price to cash flow is in its lowest 20% for its entire history. These things just don't make sense. So investors can still buy gold stocks, even though they've gone up 50% or more. In the case of some stocks like Agnico, you can still buy them because the valuations are still cheap and the cash flows and the free cash flow is still growing.
Mm-hmm. Adrian, you kind of mentioned the drivers for why gold has gone up and really left a lot of everything else behind here. Silver obviously has outperformed gold over the last 3 months. It always tends to lag. Recently we hit another insane high of 106 on the gold to silver ratio. We're now down to 92. So as we understand, let's say the structure of a typical precious metals market, silver tends to follow and then outshine gold. Does this give us any indication, do you think, of where we are in the cycle as a whole?
Yeah, that's a good question. And not only silver outperforming, but juniors for the last 2 months outperforming seniors. That's another indication, that the cycle is a bit more mature. I don't think this is a mature cycle at all. If I can use a cricket analogy, I'd say the third batsman has just come out to bat, which is like the second innings.
I was going to ask, what does that mean? Because I've never watched a game of cricket.
Well, it means we're close to the beginning.
Okay.
I think we're close to the beginning because the North American investor has only just started to get involved. And you see that with the flows into the GDX, you see that with flows into mutual funds. But yeah, you see it with the outperformance of the juniors and the outperformance of silver. And I think what's happened, because the gold stocks have moved up over the last year, not with anything like the normal leverage that you see, but because just on a price basis, they've moved up. Someone who's new to gold and silver looks and says, oh my gosh, I'm not going to buy Wheaton or Agnico at these prices. Who do they think I am? I wonder if the juniors are cheaper. And then the juniors, the price hasn't moved so much, so they buy the juniors. And similarly, oh my gosh, I'm not paying $3,300 for gold. Let's see what silver's done. I think this is a typical look at price over value. Oscar Wilde once said, there's people who know the price of everything but the value of nothing. I'm not saying that the silver stocks are expensive, don't overvalue, don't get me wrong, but the senior stocks, the senior gold stocks are still very undervalued in my mind, relative to silver stocks, relative to junior stocks. But just in and of themselves, they are still very undervalued. And, when North American investors start to pour into this sector, they're just inching in at the moment. But when they start to pour in, that's mixing metaphors a bit, isn't it? I should have said they're just dripping in. But when they start to pour in, the dentist in Oklahoma City is going to say, let's buy some gold. And he's going to buy Newmont or Barrick or maybe Agnico or the GDX. When the guy calls his investment advisor, assuming he still has an investment advisor and doesn't choose IB, he's going to say to his investment advisor, you know what, Joe, I think we ought to buy a little bit of gold in our portfolio. And the guy who doesn't know anything at all about gold stocks is going to say, good idea, Joe, let me do that for you. And he's going to look at if he's with Schwab, he's going to look at, well, what does Schwab recommend? Mm-hmm. And Schwab recommends Barrick or Newmont or Agnico, or they recommend the XAU, the GDX, and that's what he's going to buy. Mm-hmm. And so you're going to start seeing money flow into those sectors, first of all. He's not going to, that guy that knows nothing about gold is not going to buy Goldfields or Anglo, and he's certainly not going to be buying B2 or Ajax Exploration, the mythical Ajax Exploration. They're going to go to the big cap stocks first. And we haven't seen it yet.
Do you think that type of reasoning also applies to the royalty companies, the streaming or royalty companies?
Yeah, interesting question, because most people think that the senior royalty companies are overvalued. They look at how much the stock prices have gone up and they think they're overvalued. The truth is, if you look at, say, Franco, which is one of my favorites, and compare it with the price of Agnico, it hasn't gone up as much as Agnico. But nonetheless, you just look at the thing, $169 a share. Oh my goodness. That was meant to be gosh. Sorry. Oh my gosh, $169 a share. That's expensive. Mm-hmm. Again, price, not value. Now, if you look at the valuations of Franco and Wheaton, absolutely. If Ben Graham were alive today and opened his Bloomberg, if he used one, he would run away from those valuations, right? 5 times book, 70 times earnings. He'd run away. He wouldn't walk away. Mm-hmm. But the reality is that if you look at the valuations of the royalty companies today relative to their historical valuations, they're just average. They're not high at all. I'm not pretending they're dirt cheap, but they're only average valuations. And I think the business model plus the historical execution justifies high multiples, to be honest. Mm-hmm. So, yeah, I think you're going to see the generalists, the family offices, family offices, people who do a little bit of their own homework. They're going to be looking for the big cap royalty companies as well, because that's a much lower risk way of getting exposure. And you have exposure. You look at Franco, for example, they have over 100 sources of revenue, 100. So you're not dependent upon one mine, one operator, one country. Right now, the Cobre Panama shutdown, their largest single asset is about 12% of their NAV. So meaningful, but not life-threatening to the company.
Adrian, how do you think about how that capital ends up, let's say, trickling down to the juniors and the explorers? That's something that we've been very focused on in the past. Does that more speculative capital come into that sector seeking yield, as maybe we've seen in some of these shitcoin or crazy crypto markets over the last 5 years?
Yeah, I think so. I mean, again, typically the guy that calls the RIA, who has all his assets at Schwab, or the dentist who wants a little bit of exposure, they go first of all to the bigger cap names or the funds, first of all. Mm-hmm. But as those things become more expensive, and as more money floods into the sector, so a mutual fund, we manage Peter Schiff's gold fund, as more money floods into that sector, you have to say, okay, I've already got 5% in Franco, and it's kind of expensive now, or 5% in Agnico is kind of expensive now. Let's look for something else. And so money just naturally starts going down the food chain, whether it's individuals doing their homework, whether it's family offices, mutual funds, you're just naturally forced to go down the food chain.
Majors trying to replace some of their reserves.
Sorry?
Majors trying to replace some of their reserves.
Well, that's a fundamental factor. Yeah. And we're definitely going to see a lot of that. I mean, we're seeing, as you know, a lot of major companies doing ventures of some type or another with the exploration companies. You're seeing a lot more of that than you saw, let's say, 5 or 10 years ago. They're doing it less. I've noticed a trend to do fewer joint ventures, traditional joint ventures, and you're seeing more of the senior companies buying 5% or 9.9% of the juniors to get a seat at the table. Not always disclosed. Sometimes they don't have to file, obviously, if they're under 10% in Canada, they don't have to report it. But also sometimes the senior company is not wanting the junior to announce that they've got a position. But you're definitely seeing more of that. Mm-hmm. Yeah, and the seniors are in a big, even the reserves are not going to run out anytime soon. You look at Barrick or at Goldfields, they've got 30, 40 years of reserves, no problem. But there's definitely, I won't say an anxiety, but there is definitely a desire on the part of the senior companies to get more nearer term, high quality, and by higher quality, I mean high quality resources into their portfolio. And high quality includes geographic risk profile as well as just the grade and so on. Mm-hmm.
So, Adrian, where else are you focused on? Obviously, your world includes other things than just gold and silver and the miners associated with them. What else are you looking at that is catching your eye right now?
Yeah, no, good question. I mean, right now, I honestly think that the gold stocks are the best risk reward that I see in terms of a broad sector. The best risk reward out there right now is in the gold stocks, in my view. In the commodity space, we are very interested in copper. Number one would be after silver. So copper would be the number one thing we're looking at outside the precious metals. And that's because there's simply not there are not very many large deposits of copper coming on stream in the next several years. And with copper, but given that the timeline from discovery to production is so long, even a timeline from the timeline from getting a feasibility out until discovery is so long. You have a lot of visibility on what copper production in 5 and 10 years is going to look like. Mm-hmm. And even if the projections for electrification and electric cars are 100%, are double what they really are, even if you halve those projections, we still don't have enough copper in 5 and 10 years to meet the realistically expected demand unless the world goes into a global recession. So copper would be number one. Uranium is another obvious one, where the demand for uranium is just going to increase over the next 5, 10 years as more and more countries realize that nuclear power is at minimum a part of, and probably the major part of a solution to the power crisis, because nuclear power is the cheapest, the safest. People raise their eyebrows when they say that. The safest and the most reliable, very important, the most reliable form of energy out there. So those are two areas we're looking at. In global markets, we are tending to be bottom up at the moment. Obviously within a global, a macroeconomic environment, but I'm not starting from the macroeconomic environment working down. I'm looking at individual companies in very many different sectors from a bottom-up approach. We're finding a lot of good value in Bretton right now. We're finding a lot of very good values in Hong Kong, although, of course, Hong Kong has, a major risk if something should happen to Chinese stocks, such as what happened to Russian stocks a few years ago. Mm-hmm. but a lot of very good values in Hong Kong, a lot of good value in Singapore. But we're finding value in a lot of places, Brazil, Argentina. But it's a pretty eclectic group.
And you're mentioning countries in general. Are there specific sectors of those countries that are attractive to you, within manufacturing?
It is very bottom up, but let's say if you look at Britain, I mean, we would be focused more on the domestic companies and the exporters. And that would be true of most countries, frankly, because of the risk of tariffs. Mm-hmm. So you want countries where if their local currency appreciates against the dollar and tariffs are put on, you want companies that can still do well in that kind of environment. And so that would tend to not be exporters, but would tend to be perhaps companies that import their raw materials and then export, either sell domestically or regionally. But no, it's a mixed bag, to be honest. I mean, we have a real estate agent in London that we think is cheap. We have a bank in Brazil. Neat little company in Singapore that designs exhibits and museums and stores, high-end stores, and they do all the design for those kind of and special events, Formula One racing and so on. Partly that's dependent upon the overall economy, but it is not dependent upon what happens in the US and what happens in the US with tariffs. And so we're looking at companies like that, but it's very, very disparate, frankly.
Mm-hmm. Excellent, Adrian. Well, it's been a great conversation, very wide ranging and very thorough here. Is there anything that you would like to leave our listeners with to think about before we wrap up today?
Well, good question. I mean, I think one of the things I said, don't confuse value with price, is always good advice. Mm-hmm. Just because the price is low doesn't mean it's going to go up, and similarly, just because the price has gone up doesn't mean it's not good value still. Mm-hmm. Yeah, no, I think that would be the main thing. Don't think for a second that you have missed the bull market in gold stocks. I think we are very, very close to the beginning of that market, frankly. Mm-hmm. And there's a lot ahead.
Excellent. So for anybody that wants more information from Adrian, that's all available at adriandayassetmanagement.com. And Adrian, I always look forward to speaking with you, and today was no exception.
Well, I really appreciate it, Tom. Thank you very much for having me.
Always a pleasure. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.